A lot of people will ask questions like, should I, pay off my loan or should I debt recycle? Those are the wrong questions that you're asking. It's not a question of, should I pay off my loan or should I debt recycle? The question is, should you pay off your loan or do you want to invest? Those are the two questions. And if you know you want to invest, holistically, it probably makes more sense to debt recycle because then you get a deduction on your interest.
Hello and welcome back to the Get Rich Slow Club podcast. I'm Tash and I'm here with Anna, and today we are talking about debt recycling, a very popular topic at the moment. I posted on Instagram kind of recently one of my finance files, someone was debt recycling, and there were so many questions about debt recycling. What is it? Why would you do it? How do you do it? And Anna has actually started debt recycling as well.
Yeah, I've gotten so many questions on social media as well. So I'm really excited about this episode because this is actually a two-part episode. So this first part, we're going to describe what debt recycling is so that you kind of have the 101 on it. And then our second episode, I will talk about my journey so that you get an idea of what it actually looks like.
So debt recycling is a strategy that Australians use to convert non-deductible home loan debt into tax-deductible investment debt without increasing your overall borrowing. So you're taking something like your home loan, which you can't claim as a tax deduction, and magically making it a tax deduction somehow.
Yeah, so the one of the things to kind of consider when you're doing this strategy is that it's more of a tax strategy than it is an investment strategy. So the biggest benefit around this is actually the tax savings. So let's just talk about a little bit about what it is and what it isn't. So it essentially converts your home loan, which isn't deductible, into an investment loan.
So usually with investing, most of us, I assume, we make money from our jobs. We may save it and then we save up and we invest it. So it goes straight from our bank account to our brokerage platform. This is a different way of doing it.
Yes. So instead of investing spare cash directly, you first pay that cash into your home loan. Then you redraw that same amount and invest it in an income-producing asset. So typically this is shares, ETFs, or it can also be an investment property. The key is that you haven't actually increased your total debt. You've just changed the portion of what it's used for. So previously that debt was for your home loan. Now you're using it to invest.
So you put it into your home loan and then you somehow take it back out.
Yes.
Magic. This is different from borrowing extra to invest, often called leveraging, which does increase the total debt and risk. Debt recycling instead focuses on repurposing existing debt so its interest becomes deductible. So to debt recycle, you need to own your own home and live in it.
Yeah, so essentially by having a home loan, which isn't tax deductible, you make it tax deductible.
So it doesn't make sense for me personally. So I rent at the moment and I have 2 investment properties, but both my investment properties are already tax deductible because they're investments. Mm-hmm. So it would only make sense for me if I bought a home and then lived in it, which is why it's working for you. You don't own your own home outright, but you have a mortgage on your own home.
Yes. And so by having my own home, I don't get a tax deduction on that interest. So why not actually make it tax advantage for myself by investing it by using debt recycling?
Yes. So with what you can claim actually is like you can usually claim the interest on the mortgage. So not the principal repayments, but you can claim the interest on those repayments, which is pretty cool.
Yeah. So we've kind of explained this, but it is a bit confusing. So this is why we're saying it multiple times. So the goal of the investment funds is to produce or aim to produce an income. So that's kind of the idea of why you are pulling out an investment loan. Then the interest on that loan is deductible. So that's kind of the goal, right? With your own primary residence, you don't have income that's coming in. Whereas if you are investing it or if you're buying a property, that's kind of the goal with that. And therefore, that interest can be tax deductible in this kind of sense.
So that means that your effective interest cost falls by your marginal tax rate.
For example, at a 6% loan rate and a 32% marginal tax rate, so this includes Medicare levy, the effective cost on that split is roughly 6% times 1 minus 0.32 equals 4.08%. So higher tax brackets magnify this benefit.
That sounded quite confusing to hear. It's really hard to hear numbers being read out loud, especially with math equations. So here's another example. Let's say you had a $100,000 loan on your home with an interest rate of 4%. That would be nice. That means you are paying $4,000 each year in interest. If you were able to convert that to a tax-deductible loan, you would be able to take that $4,000 off your taxable income. And if your marginal tax rate was 30%, you would pay 30% times $4,000 equals $1,200 less tax each year. The result is that the government effectively pays for 1.2% of that 4% interest, and you are only paying 2.8% interest.
And the magical part of all of this is that compounds over time. So that's just 1 year. But if you're doing this on a loan that's 30 years long, that then compounds, that saving compounds year after year after year.
So in summary, you are turning non-tax deductible debt into tax deductible debt by making it for an investment purpose rather than like a personal purpose.
Yes.
Cool. So how do we actually do it?
Okay, so there's a couple different ways that you can set it up. Is if, for example, you have money in your offset, you can then pay that into your loan and then pull out a new loan with that separate amount.
So you pay it into your home loan and then you go and apply for a new loan.
Yes, you can do that through your bank or through a broker.
So I guess it's like a bit confusing when I hear like pull money out. I think like you're going to redraw the money back or you're going to like just take it out of your offset account, but you're going to pay it in, leave it in there, and you're going to have a second loan.
Yeah, and you have to actually make a separate loan. So that's the big kind of confusing part. You do not want to mix that money because it's a separate loan. Some other people do it right when they purchase their property. So let's say you are buying a property and you're going to have a $500K loan. Right at that time, they'll be like, hey, we actually want to split it into 2 loans. So I know that sometimes that is done at that point, at the point of purchase. But the idea is that you don't want to have one loan. You don't want to mix it up. You actually want to have a separate loan that's for investment purposes because it makes it easier to then actually do your taxes, talk to your accountant. And it's not like some of this money is for the investment loan and some of it isn't. And I've now mixed it up because I'm not tidy.
Throwing it all together. So you see your accountant and you see a mortgage broker.
Yes.
Amazing. What does the accountant help with?
The accountant can just check whether this is a good strategy for you, whether it's tax effective. They can run the numbers for you. They might also have to sign off on it if you're going to do this loan through the bank.
Okay, interesting, fun.
So once you have this new loan with this money, you then would go and invest that money. So whether you would buy an investment property or if you want to invest it straight into shares, the idea is that you would take it directly out of your bank account and invest it right away. So that's kind of clear to your accountant and to the ATO that this is actually for investment purposes. So then you would then go and invest that money, and then you would need to keep track of it. So what have you invested in? How much did it cost? What your interest is? And that way, when you're doing your taxes, you can then claim that interest against your tax. And now people sometimes actually continue to do this. So once they save up some more money, for example, in an offset account or in a redraw, they might then go and resplit that loan and do this again and again.
Resplit which loan?
So the loan that they potentially have paid off or money that they have against their house loan. Yeah.
Okay.
So the idea, so for example, let's say you have a $500K loan.
A $500K home loan.
500K home loan. Yep. Thank you for clarifying. We don't want to confuse anyone. 500K home loan. You have 100K in the offset. You then decide to pay that into your home loan. Then you decide to
split the loan and borrow $100,000.
And borrow 100K. Yeah. And now you have a 400K home loan and a 100K investment loan. And then you invest that 100K. And then time goes by and you start saving money and you put it in your offset account. And now you have another 100K. And what you do is you pay it off again and you pull it out as an investment loan.
So now you split the home loan to take out a second investment loan.
Yes. So now you have a 300K home loan, 100K investment loan, and another 100K investment loan. So the debt is exactly the same. It is the exact same debt that you have. You haven't increased your debt. The only main difference is now your money is a little bit more diversified because you've invested it and you get to claim a tax deduction on the interest of your 2 investment loans.
So do you have to pay off extra to then take it out? Because I know with a lot of banks, you have to keep the 80% LVR if you don't want to have to repay for lender's mortgage insurance. So you need to make sure that you have enough equity in there. So once you're paying off your minimum repayments, do you have to pay extra to then take it back out, or can you take out those minimum repayments? This is a really great question. It's one that you would want to talk to your broker and your bank account, because a lot of banks, from what I've understood, aren't a huge fan of this because they're more comfortable with you buying property than they are with you investing in shares based on like using a loan for that. So you might want to talk to them about what you can and can't do. But the big idea is that for debt recycling, that you are already using you're not increasing the loan. So some people might be like, well, can I use equity and do that? Like, can I pull out equity in my house and get an investment loan? Well, you can, but you're going to increase the loan amount that you've had. So it's slightly different than what we're talking about right now in terms of that kind of debt recycling. So you can do either, but talk to your accountant or broker, because also your borrowing capacity might have changed between when you got the home loan versus now. Maybe you've had kids or you are going part-time and you might even not be able to borrow the amount.
And that was exactly kind of what happened for us because I'm working part-time. So our incomes are different. So we did need to kind of run the numbers and see what we could and couldn't do and what the bank would allow us. And we were told, like the bank probably won't lend you this much, but they'd be willing to do this much. Or maybe you want to go to a different bank. So it is really important to talk to a broker and have a good understanding of what your options are. Because just talking to your bank, you might get a better rate elsewhere, right?
Mm-hmm. It sounds quite confusing.
Yes.
So why would anyone bother when they could just put the money in the offset?
Yeah, this is a great question. So a lot of people will ask questions like, should I, pay off my loan or should I debt recycle? Those are the wrong questions that you're asking. It's not a question of should I pay off my loan or should I debt recycle? The question is, should you pay off your loan or do you want to invest? Those are the two questions. And if you know you want to invest, holistically, it probably makes more sense to debt recycle because then you get a deduction on your interest. But if your goal is not to invest, then it's not a question of should I debt recycle or should I pay off my loan? Does that make sense?
Yes. Yeah. So decision one, do you want to invest or not? Taking money out of an offset to invest increases the interest you'll pay each month. So it's similar to borrowing to invest. Whether you want to invest or not, obviously depends on your risk tolerance, your goals, your time horizon. You always need to compare the interest rates as well with maybe what you might get from your investment. So as home loan interest rates are dropping, it might become more and more attractive to invest. But when interest rates are higher, maybe it's less attractive to invest. It really depends.
And that's exactly that. I think with this topic of debt recycling, we're just trying to kind of run the basics here, but there are so many different things that kind of come into play, right? Your interest rate, how much more do you have to pay off your house? What's your risk tolerance? What's your time horizon? When do you want to pay off your house? How much do you want to invest? Are you going to continue to debt recycle over a long period of time? There's so much to think about.
Do you want to start a business? Do you want to buy another property? It all depends. So I think this question is not, do I debt recycle or put my money in an offset? It's do I want to invest? Yes or no? Then how do I want to invest?
Exactly. That's the right questions.
We still love offsets though. Offsets give you a risk-free, tax-free equivalent return equal to your mortgage interest rate.
Yeah. And that's something that you don't get taxed on, right? You're saving that money holistically, where you have to remember when you are investing, the whole goal is to have an income producing asset, right? You're investing in an income producing asset. So if I'm investing in shares or ETFs, the goal is that I'm going to get dividends or distributions, and you are going to get taxed on that as well.
And you're hoping that you will earn more than the interest you're paying on the loans.
Yes. So there's a lot to consider of why you want to debt recycle.
Let's talk about some common mistakes. I'm sure there are many because it feels like it should be simpler. I'm sure it's simple once you do it with an accountant and maybe a financial advisor and your mortgage broker, but from the outside, it seems like you're almost like legal money laundering.
Yeah, that's honestly what it feels like. I always I've joked about this. It's like white collar laundering legally, right?
It's ridiculous. It feels like you should just be able to be like, hey, I've got shares. Can I not just tax deduct some of my mortgage then? Off topic completely. But I feel like we should, as a society, to make things a little bit more equal, we should have a tax-free amount that you can have for any investment, whether it's shares or your home. It shouldn't just be for your main home. That's my belief.
Yeah, I think that there's a lot of things that we can do policy-wise to make it a little bit
kind of stuff.
Well, just to make it more equal, because what we're talking about essentially is people who have access to some kind of wealth getting more tax advantaged opportunities than people who do not.
And not just, people who have access to a home, you can get all of that tax-free initially, incredible. But then people who have access to people to talk to this about. If you have friends who are debt recycling, you can ask them questions. If you have access to pay your accountant more money, if you can pay a financial advisor, maybe they'll suggest this to you. But if you're just someone who doesn't talk about this stuff, how do you even know that you can white collar money launder your own money to get a tax deduction? It just seems
legal white collar.
Yes.
Money
Play
laundering,
the game.
Yeah.
Anyway, mistakes.
Yeah, but I think it's important to talk about these systemic issues because a lot of these policies come into place, make the rich richer and make those who are disadvantaged more disadvantaged.
It's just feels like it's creating fake work because the work doesn't need to be done. I love accountants, financial advisors and mortgage brokers, but this whole process is could you not just give me the tax deduction anyway?
Yeah, fair. I have to jump through these hoops of talking to a few people and getting things done. Yeah. So it does seem a little bit more complicated. And when you kind of knuckle down, it makes sense, right? You're taking your non-tax deductible debt and making it tax deductible. But there are a lot of mistakes that you can make along the way. So it is worth talking to someone. And it does get more confusing as you dive deeper into those topics of like interest rate or what you want to do, whether you want to invest, is it property, is it shares, etc. So let's talk about some of the most common mistakes and how to avoid them. The first one is mixed loans. So you want to make sure that your loan is split. You don't want to somehow intermingle your personal spending and your investments. This makes it really hard to track. And mixing what is deductible and non-deductible makes it a huge mess for your accountant and potentially might actually void your investment loan in the sense that you can't really claim a deduction on it. So make sure everything is split properly, do proper accounting, talk to your accountant if you need to, but like make sure it is not mixed. That is something that I've heard so many people say, and something that we were very diligent about when we actually split our loan as well.
And then make sure you move this money directly into a clean brokerage account, I've heard some people say. So don't have some random $5 in there from something else or whatever it is. Make sure it's completely clean and then invest it straight away.
Yeah.
Avoid assets with no assessable income. To claim interest, the borrowed funds must be used for assets that produce or reasonably aim to produce an income. Be careful with choices that intentionally switch off distributions. So don't go and buy all Tesla shares because they don't pay dividends.
Yeah. Or, the other thing is if you have a dividend reinvestment plan, like just it might make more sense to get the dividends paid directly to you instead of confusing yourself and now all of a sudden you've reinvested those dividends.
Yeah.
So just another thing to take note of.
And with that, make sure you keep proper records of what you've been doing.
Yes, get your Excel sheet out, write it all down. It's going to make your life so much easier in the future.
Also be aware of cash flow strain. Dividends aren't guaranteed and they can be lumpy. I've noticed sometimes you get bigger dividends in January than you might in March, April, for example. So just be mindful of that and make sure to keep a big buffer in your offset.
Absolutely.
Okay, let's talk about what you actually do with this money now. So we've magically got 200 grand out of our home loan. How do we decide whether to buy property with it or maybe just buy shares with it?
Yeah, great question. Again, another one that would be really great to talk to a financial advisor if you can, or even just a broker. I think that talking to a broker about what your options are or where you want to invest this money is a really good one.
Brokers can't give you advice on what to invest the money in.
No, yes.
I think a lot of sidebar again.
Fair.
Some brokers on social media, I think, are giving more property advice than they should. So also be wary if you talk to a broker who deals with property if they're giving you too much property advice.
Yeah, one of the things that was really useful with the broker that I spoke to was just running the numbers on both situations.
Yes.
So that's kind of what you want to do and what the best option is for you.
And think about what you would do if you weren't borrowing this money against your home loan or against your current home. Like, were you planning on buying another property? Were you planning on investing in shares?
Were you planning on just leaving it in the offset?
Yes.
They're all like perfect, reasonable options.
You can also get like any loan. You can also get interest only or principal and interest.
Yeah, so there's a couple different loan options, and I know that it is less common potentially now to just get an interest-only loan. They were really popular a few years back, but I think they got a bit of a crackdown. They do make more sense if you are going to deduct a lot of tax from your interest. So if it does make more sense potentially to have an interest-only loan.
The reason banks don't like lending to people with shares rather than property is because shares can drop like 30% overnight. So I guess the problem with only having interest only is if the share market drops 30% overnight and your shares go from 100 grand to 70 grand, but your loan is still 100 grand and you've never paid it down because you're only paying interest only, all of a sudden, if you sell all your shares, it doesn't matter because you've still got a 30 grand loan left over, which can be quite terrifying. So proceed with caution, make sure you're holding on for the long term and be aware that shares can drop overnight. Property, we don't see the same drops just happen out of nowhere. So it feels a little bit more stable mentally to see it that way.
Yeah, and it might not even be an option. It really kind of depends on the lender and on you.
Yes.
So who might this be suited for? Someone who has their own property that they live in. So their principal
place of residence. I like this other point though, that you'll keep for a while. So don't live somewhere and think you're going to sell next year and then all of a sudden have all these messy loans you need to possibly pay off.
Yes, it can get very messy if you're planning on moving in a little bit. You also want to make sure that you earn a stable income. And that you have a healthy offset buffer, right? If you're not getting dividends or distributions getting paid out, you want to make sure that you actually have money to cover that loan because you're going to be paying that loan. It's not free money. You also want to make sure that you're in a moderately higher tax or income, or at least this has a bigger benefit than if you're in a low tax income.
Yes. So if you're in that, 30% or 45% tax bracket.
Yeah.
It'll be more beneficial.
Yeah. And also you want to make sure that you can tolerate market volatility and have a long-term investment horizon. There's nothing worse than being like, all right, I'm doing this. I'm going to debt recycle. I'm investing in the share market. And then all of a sudden it drops and you are like, oh my, I made the wrong choice. So you just want to make sure that you know what you're getting into, because chances are when you are debt recycling, there are bigger loans. They're not just, $1,000, they're maybe 10, 50, 100K that you're kind of investing at a time.
Also, be very honest with yourself about whether or not you are good with admin and you can keep good admin. Because I am hearing this stuff and how onto it you have to be, and I just don't think this is for me unless I can pay someone to do it for me.
Are you stressing already? You're like, oh my gosh, it sounds
just like
chaotic.
Yeah, I hated the switch from being a sole trader to having a company because it feels like there's so many more responsibilities. And before, when I was a sole trader, I would just mix my money. Whereas now you have to be very you can't just mix your money. It has to be very separate. And this feels like the same thing where you have to be onto it and you can't make mistakes. It can be fixed, but it just seems like it'd be a headache down the line. So be very honest with yourself. Make sure you've got a good system set up, or see if you can pay someone to help you.
Yeah. So those are some of the reasons that this might suit you, and here's some that would not suit you. So why you should avoid or delay this. One is that you have a low risk tolerance or a short time horizon. You might see those downturns and lock in those losses, and that is not ideal. So this might not be right for you.
Some shares are a high risk strategy a lot of the time. This is an even higher risk strategy because you're not investing your own money.
Yeah, you're investing the bank's money.
Yes.
So yes, it is very high risk.
Avoid it if you are expecting to turn your current home into an investment property soon. You're going to be able to tax deduct it anyway as an investment property. So no need to bother doing all of this if you're going to make it an investment property anyway.
Plus, from my understanding, it might make some of the loans a little bit confusing because they're still tied to that first loan, which is your own home loan. So this is where you definitely want to talk to someone before you do this.
Yes. If you have uncertain income or thin cash flow, so you always have to pay your loans back, even if your dividends are cut or there's a big drop in the share market or interest rates rise, you will keep having to pay it back. So make sure you're in a very comfortable position first. Okay, that was a lot, but yay, we got there. I feel like if you it sounds simple in my head where I'm like, great, you want to make a non-deductible asset into a tax-deductible asset. You're just trying to get something that you can't get a tax deduction into something that you can get a tax deduction on. And then there's the complex system of legal money laundering that you go and do to get there. But overall, great.
But a step before that, that we just talked about is already knowing what you want to do with that money. So for example, if you have money in the offset, do you pay off your home loan? Do you leave it in the offset, or do you want to invest it in something else? That is the first question. And then when you answer that question, if you're like, oh, I want to pay off the home loan, or I want to actually invest it, then the question is, how does it make the most sense to invest it? Does it make the most sense to just pull it out of your offset, invest it? You can totally do that. That is totally fine. That is your money. You can do whatever you want. Or you can use the bank's money, which is pay it into your home loan and then pull it back out. So it's a loan, which is a bit more risky, but then you get the tax advantage. So that is the first question that you want to ask before you do this, not whether, should I pay off my house or debt recycle? It's no, do you want to actually invest? What do you want to actually do with that money? And that is the first question. And all those other things, your risk tolerance, your time horizon, your ability to stomach the market, that all comes into play.
We're going to do another episode next all about Anna's journey with debt recycling and why she decided to do it. But I think a good point is to highlight just how long you've been talking about this. This wasn't a random decision you made. This was something that was very well thought out. So stay tuned for part 2.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest, or me at Ana Christina.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Ana Christina from Perla. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging.